Welcome to the weekly guidance. In this video, we'll take a macro overview of the global financial markets and economies, and provide you with some suggestions on how to position yourself for the near future events. Looking back to 2022, the highest inflation in 40 years for the world's largest consumer economies, was initially judged as transitory by the Western central banks, later resulting in the most aggressive rate hiking cycle in decades. Here we can see that the US inflation reached 9%, while EU and UK CPI nearly touched the 11% mark. On the next slide, the Fed fund rate is skyrocketing to 5%. As well as the ECB and BOE lifted rates to 3.5 and 4%. Global central bankers may have been behind the curve initially, however, their current stance on fighting against inflation appears to be solid as a rock. The big question is whether global economies can bear the consequences. On the other hand, the world's largest exporter China experienced an unprecedented collapse in its housing and lending market, toppled by aggressive knockdowns of major cities of the zero-COVID policy effort. Geopolitical tensions have been on the rise sharply with Russia's attack on Ukraine, the NATO response to fight them back, as well as the Chinese-US relations deteriorating quickly over the issue of Taiwan and the One China policy. No wonder, the traditional 60% bonds, 40% equities investment strategy has suffered all year in 2022 as both the bond and the stock market got hit by the challenging environment. The US government bonds were supposed to be the savior during stock market declines, however, this time the bond market crashed as the interest rate rises and higher inflation got priced in. In the currency market, volatility suddenly came back with a vengeance, as the US dollar rose sharply to a two-decade high, while almost all of the other major currencies experienced a heavy drop in value. The super strong dollar put a lot of pressure on emerging markets and the rest of the global economies as well. The fallout so far include the bankruptcy of Sri Lanka and Pakistan. On the commodity front, the war between Russia-Ukraine lifted the price of oil, natural gas, and a bunch of other commodities. There was incredibly uncertain if Europe will be able to deal with the upcoming winter without Russian natural gas supplies. The price of crude oil rose to the highest level in 14 years, while the European natural gas market hit insane all-time highs. The crypto market got completely hammered, with many of the industry key players filing for bankruptcy, and many customers losing their crypto assets. The fallout of Luna, FTX, and Three Arrows Capital hit the industry extremely hard, with dark clouds gathering above Binance and many other players as well. Bitcoin erased more than 2021 gains in the last year alone, resulting in huge losses for many. Perhaps the most worrying of all, the global dollar funding markets experienced high levels and sustained stress like we had not seen since the great financial crisis. Heaviest yield curve inversions in decades predict a high level of perceived economic uncertainty ahead, as the bond market believes global central banks might raise the rates even higher, but eventually they will need to cut aggressively. Moving on to 2023, while on the surface level, the labor market still appears to be strong and tight, many of the largest tech companies announced massive layoffs are coming. Keep in mind that the labor market is the last one to go under, so we need to look at other factors to position ourselves better for the near future events. The economic leading indicators are all pointing to a significant economic slowdown, consistent with the message we are getting from the yield curves. The consumer is highly pressured, with personal savings rates at historical lows, and credit card debt at all-time highs, while interest rates on credit card debt are nearing 20%. These developments put extremely high uncertainty to the outlook of consumer spending, and therefore to the backbone of the Western economies. The export data of the world's largest exporters, China, Singapore, Korea, and Japan suggest a major weakness in global demand. The fall of crude oil prices and recent buildup in domestic US inventories, given the extremely tight production, points to the same weak global demand picture. The coincident growth figures such as industrial production, real income, retail sales volumes, and real loan growth, all point to negative growth for much of the world. The exemption is China growing at 5% and the US is stagnating at around 0%. As we are almost at the finish line with the 2022 Q4 corporate earnings season, the results are somewhat concerning. The S&P 500 turned into negative earnings growth of nearly -3.5%, the lowest since the pandemic. The earnings surprise factor came in at 1.1% so far, the weakest since the Great Financial Crisis. If we exclude the outstandingly profitable sector of energy, the earnings growth is even weaker, below -7%. The energy sector benefited largely from Russia's war on Ukraine, sanctions, output cuts, and general undersupply and tight inventories. However, the price of oil has come down sharply, and from the inventory data, the demand seems to be softening. That suggests energy companies might not be able to achieve comparable growth in the current year. On the revenue front, higher inflation boosted the results. The aggregated revenue growth came in at 5.7% nominal, with a 1.8% surprise factor. While nominal revenue growth has been falling sharply from 2021 Q3 extreme highs, it is important to compare the nominal data with the inflation rate. When we compare the nominal revenue growth with the inflation data, we can observe that in the last quarter of the year, the inflation rate outpaced the nominal revenue growth. That suggests demand problems and a drop in sales volumes. Meanwhile, the Western stock markets appear to be the most overvalued since 2007 and 2001 relative to the bond markets. Investors might consider revising their exposure to the global equity markets. With all the uncertainty ahead, the US stock market pays the lowest risk premium in 14 years, as well as the German DAX index suggesting major weakness in the near midterm. The sustainability of the debt levels with the current interest rates is extremely questionable, with massive refinancing kicks in this year and beyond. To refinance the current global private sector USD debt load would cost 4.2% of the world GDP as an annual interest above the expected average inflation. Lastly, we must keep a laser eye on the developments in the money markets going forward, as in March, due to a seasonally strong dollar demand, funding pressures came back with a vengeance. That is a huge stress event for risk assets such as the stock market and high-yield bond markets, especially at current rich valuations, while creating a potential upside scenario for the US dollar. Worth noting that as of March 9, the September 3M Libor contract was pricing at a 0.35% higher rate compared to the April contract, which turned around shockingly fast to the price at roughly a full percentage lower rate. The magnitude of the change is one of the largest on record, raising serious concerns over systemic issues. No wonder the financial system appears to be breaking down due to funding pressures and unsustainable refinancing costs. As money markets showed signs of stress, for banks went under so far. 16 billion Swiss franc worth of AT1 junior credit Swiss bonds will likely be marked down to zero. While the exact path of spillovers is extremely hard to predict, we can conclude that the financial system will likely be heavily engaged in deleveraging and de-risking its balance sheet. Such activities will certainly make credit less available and might cause further fallouts of institutions and breakdowns in financing chains. Keep in mind that after 2008 a significant amount of risk-taking was transferred to the non-banking financial sector, so investors might widen their scope when assessing risks. Either way, the events are likely to pose a huge drag on the already weak global economies, with further consequences to be seen. In case of serious monetary stress, gold is a safe haven asset to consider, especially when global bond yields start to fall. The potential geopolitical headwinds such as Ukraine, NATO, Russia situation keeps escalating, Iran, Israel, NATO and Taiwan, China, NATO factors can explode anytime. These events would probably create upside pressure for gold as well. Given the current headwinds and valuations, the safest long-maturity US government bonds, and perhaps German government bonds, looks attractive for the medium term with significant upside once inflation comes down due to the lack of funding and weak economies. Meanwhile, the major central banks start cutting interest rates. Considering the highest real yields in the last 10 years, US long-term government bonds suggest an investing opportunity. Thank you for watching the weekly guidance. We hope you found this information helpful in positioning yourself for the near future events.